The big picture here is understanding that the two most important factors are fiscal and AI. The only way we can fix in a really easy way without a recession or without inflation is by having a productivity boom. And so fiscal needs AI, monetary needs AI, and the overall market needs that productivity boom. And so the notion that we're going to go and try to stop an AI bubble, I think is misguided right now. The Fed's best shot at long-term stable inflation is AI. So for them to keep it tight or even tighten to slow the AI bubble is actually very much counter to what they're trying to achieve.
This episode is brought to you by Fiscal.AI, the fastest growing stock research terminal on the internet. You'll hear more about Fiscal later in the show. Let's get into it. Very pleased today to be joined by Dan Krausz of Blue Door Asset Management. Dan, welcome to Monetary Matters.
Thanks very much, Jack. Happy to be here.
Dan, I know there are two major macro factors that you are paying attention to that are driving the economy, driving markets. What are they, and why are they so important?
So right now, the way I think about markets is you have the fiscal side, which has incredible importance now for both the economy as a whole, for different parts of the economy, as well as for the Fed. And then the second most important macro factor is AI. And I think most people think of AI as a micro factor more than anything at this point. And I think it actually is an enormously important macro factor today and going forward.
Let's start with AI. I mean, the CapEx this year is probably going to be over $400 billion. It's contributing meaningfully to GDP. Perhaps a majority of the growth is from AI this year, AI CapEx, I should say. Why is it so important, Dan? And also, I kind of want to start with a chart that you have shared with me before, which shows the relationship between profit growth and employment growth. The implication being that normally a weakening labor market is bad for the stock market. However, if earnings and revenues keep on going up as the labor market weakens, that's not necessarily bearish. In fact, can be very good for the stock market because profits are rising.
Yeah. So historically, poor employment is bad for markets. I don't think that's very controversial. Except that what we have to understand is how the cycle usually plays out. And the way the cycle usually plays out is that profit margins tend to weaken first, right? And then you start to see employment start to weaken. And that's an important difference because what we worry about with recessions and with employment, I think a lot of people point to recession as two negative quarters of GDP growth. And I think that's kind of a silly definition. What we care about is this reinforcing negative cycle. And what happens with a reinforcing negative cycle is margins start to weaken, then you're cutting employment, then you get a lack of demand because of the employment cuts, which further weakens margins, which further weakens employment, right? And that's when the Fed has to step in and the fiscal side has to step in to kind of break that negative cycle and turn the cycle back up. What's happening right now is quite different. Profit margins overall, not in every industry, but overall are on their highs. And so employment has been weakening with profit margins on high is not actually bearish in and of itself. And that is a big difference relative to history. And so what we've been seeing is not that the employment weakening is because of weaker profit margins. This time, it's actually in part because of stronger profit margins, right? Because you don't need as much employment to create that top line growth. And therefore, you're driving the weaker employment and the stronger profit margins together. And that's what makes it a very different scenario than historically when we've seen weaker employment. Now, obviously, there's a limit to that, right? If we get massively negative employment, that's going to start to create real concerns for companies. But right now, what we've been seeing, as long as you're seeing margins tick up, you shouldn't be as concerned about the weaker employment from a market's perspective.
Where does this lead? Can the employment continue to weaken for a long period of time and margins continue to go up, profits continue to go up?
So I would say employment can stay weak for a while and margins go up. It can't go negative for a while. And that's an important distinction. So far, we really haven't seen the negative side, but we've just seen the weak side. That can continue and is likely to continue. And it goes to AI as kind of one of those two most important macro factors going on, right? The big question on AI is, can it create a productivity boom? And then I would say the second question of that is, does it matter, right? And I think AI is so crucial, and we'll get into a little bit later on the Fed and why it matters so much. But the truth is, when you have fiscal deficits of 6% in an expansion, that creates natural pressures to inflation. That's out of the Fed's control, right? The Fed doesn't get to control the deficit on the fiscal side, and many Fed chairs have spoken about that, right? But the Fed's best shot at stable long-term inflation right now is a productivity boom, because you have those natural upward pressures from the deficit. Our best shot at a productivity boom is AI. And so AI is actually the Fed's friend right now and is crucial for the overall macro environment to stay in this kind of low inflation, high profit margin regime. Now, productivity, the problem is that productivity is notoriously impossible to predict and to model. But what's super interesting is probably the best predictor of productivity that I've seen is actually just simply the S&P 500 PE. So if I look at 5-year average productivity, the S&P 500 PE just tends to lead that. Not perfectly, obviously, but directionally it's pretty good. And so right now, the markets are saying, yeah, that productivity boom could definitely be coming. And that's important because it's crucial to being able to do a whole host of things. It's crucial to be able to keep inflation lower in a high fiscal deficit environment. It's crucial to allow the government to grow out of that debt in a non-problematic way and allow the Fed to ease more. And it's also crucial to being able to maintain the S&P multiple at a higher level for a longer period of time. So the answer to the question is of can AI drive productivity boom? Markets certainly think so. The answer to the question of does it matter? The answer is definitely yes. However, the way I hear people talking about that AI and productivity boom, I think gets a little bit murky when it comes to profit margins, which is really where the rubber hits the road. And so the history of productivity booms is actually not that you get this universal rise in margins. So it's just less simple than that, let's say, right? So if we look at it kind of the other way, the last 20 years was a period actually of weaker productivity growth, but actually quite strong margin growth. And this owes to what I would say is the difference between capital productivity and labor productivity, which I don't want to get too, wonky here, but the point is we became much more capital light. We were able to do a lot more with less on the capital side, and that drove higher margins, but even as labor productivity wasn't necessarily all that strong. So that's number one. In terms of when you look at it the other way, we did have strong margins even in a weaker productivity environment. It's not impossible to have stable to weaker margins in a strong productivity environment. The second aspect is let's just look at history, right? The recent history is, a couple of productivity booms that we had in an isolated way. So you had the cloud, right, which was great from an IT perspective. Except when you look at the margin gains and even the market cap gains from the cloud, it really went to software companies. Right? Those companies implementing the kind of cloud software, the impact was almost unnoticeable on their market caps, the recipients of it. However, the software companies were booming for years. That's number one. The second one is Shale. So Shale was, the greatest productivity enhancer in the history of energy. And it turned out to be the worst thing that happened to a lot of energy companies. There were a lot of energy companies that went out of business because of it. So why is it in such a productivity boom? Why didn't we get higher margins? And the answer is simple. The gains all accrued to the consumer. They got competed away very quickly. And so when you think about the productivity boom, we really have to think about the industry structure around the companies in order to understand what the impact is going to be. And so if we think about that as the difference between an enabler of productivity and a recipient of productivity. An enabler of productivity sees higher demand, higher top line, better operating margins as a result. The recipient of productivity really depends on the structure of their industry. If it's a normal competitive industry, that productivity is likely to get competed away. And so I think there's a lot of nuance here, rather than just thinking about AI as this grand, process of creating higher and higher margins. There's really a lot of nuance to think about, how does it matter, right? And that then feeds into the idea of why have we had such strong ROIC and margins over the last 40 years, just trending higher, right? Even as we didn't have that strong labor productivity. And what does that mean for the future? And so the way I break it down is the last 40-year rise in returns on capital and margins were really driven by four main factors. Not to say it's the only factors, but they were the biggest ones. And the first one was moving to a more capital light economy, which you mentioned earlier. So CapEx as a percent of profits continually fell over the last several decades. That process seems to be kind of over for now, right? Maybe we go back to that once we get the infrastructure all built out for AI. But for now, it's becoming more capital heavy again, if anything.
Way more.
Yeah.
Way more. I
Exactly.
mean, just like 4 companies are going to spend hundreds of billions of dollars, like close to $400 billion on on capital expenditures. These companies are deploying enormous amounts of capital.
Right. So the tailwind of moving to a more capital light economy, that's behind us. Okay. The second was falling tax burden. Over the last 40 years, corporate taxes as a percent of profits have been continually falling. And they'll fall again next year with the full implementation of the big beautiful bill. That likely is behind us as well, though, after this next year. It's hard to see material tax cuts from here based on what's going on in employment, on the what people like to refer to as a K-shaped economy. It's going to make it from a social perspective harder and harder. And so, I'm not here sitting saying, well, taxes are about to go up a lot, but the tailwind is kind of gone. The secular tailwind we had is probably plateauing now. The third one was falling debt service burden over the last 4 decades. Right? Every year we were seeing lower interest rates, but not just lower interest rates, all-time low interest rates, right? And so that was continually lowering the debt service burden, which also helped returns on capital and margins. That game is over, right? And it doesn't mean debt service has to rise materially, but the notion that it's this tailwind driving better margins and better returns on capital is really behind us. And then the fourth one is falling labor costs as a percent of profits. And that's where it gets interesting, right? Because it's easy to look at that chart and say, well, how much lower can this go? But the truth is, you could have said that 10 years ago, 15 years ago, 20 years ago. But that's where AI comes in. And in order to have a driver, not just of the AI implementers, but the broader economy seeing higher returns on capital and higher margins, you really need AI to create that labor productivity such that labor costs as a percent of profits can continue to fall and be that tailwind. Because the other three major tailwinds are almost certainly behind us.
So 4 things that they're good for capital returns, capital productivity, and profits. The stock market, low capex, falling tax burdens, and low interest rates. The first 3 are done for now, at least for the next several years. So really, the only way that capital productivity and return on invested capital can go up is from labor costs as a percentage of revenues going down. Do you think that's going to happen? If so, do you think it's going to happen by the workforce going down, either from outright layoffs or just not hiring people and then letting natural attrition happen? Or is it everyone has a job, employment is strong market, but everyone's just doing 5 times as much?
That's a great question. It's probably the question. The honest answer to the question is I don't know, because it really depends on a lot of factors. First of all, how AI progresses from here, what the implementation models are. Is it happening at the corporate level as much as we hope and expect? I wish I had a real concrete answer for you there, but I think the most important thing to understand is not necessarily predicting what will happen, but understanding what needs to happen and understanding what you need to watch to really know what the environment is. And so what we've identified is those 4 things were what you needed to watch for the last 40 years. Now it's just that one from a margin and return on capital perspective. And I think that is absolutely key. We'll see. We'll get signposts along the way. But I think it goes to the next point, which is how do you position for that, right? Because what I want to make sure is that if I'm positioning for it, that I'm not at risk of the extremes of what you just described. And the way we think about positioning for it is kind of these 3 rules of positioning that we talk about internally. Coming back to it, remember what the 2 major macro factors are: fiscal and AI. Okay? What fiscal does is it creates unevenness in the economy when you have a 6% deficit, because it is having an influence over what happens in the economy to a much greater extent. So, for instance, over these last 3 or 4 years, fiscal has been enormously important in picking winners and losers, but it's not just directly picking winners. The fact that fiscal is keeping interest rates higher than they otherwise would be, right, because of all the injection of stimulus, means that if you're an industry that's not getting the benefit of fiscal, then all you're doing is getting the negatives of higher rates and none of the positives of fiscal stimulus, right? And that's what has kind of played out here with the way the Fed has played out and different industry performance. So you have the AI side, which is strong. Obviously, the concerns about a bubble tell you that rates are not too restrictive for AI, right? But then you have the second bucket that we look at, which is kind of the small businesses and ISM cyclical industries. And that area has actually been quite hurt. The ISM has been at below 50 for the longest period that it's ever had. And what happened there was essentially those areas, like small businesses and the ISM sensitive areas, other than the fiscal beneficiaries, got all the negatives of higher rates. And so they've been held down for a while. And then the third one is housing. And housing is another great example of that, and an even more extreme example, actually, than the small businesses and ISM sensitive areas, where they got all the negatives of higher rates and really got none of the positives of fiscal outside of 2020 and early 2021. So this kind of brings us to that first area of importance, which is fiscal and its impact on the economy as a whole and its impact on monetary policy. Because right now the Fed is struggling with whether to cut again, right? We're seeing that internal struggle come out in markets. Markets are doing exactly what they always do when the Fed says, well, we may not provide as much help to the economy, right? What I think the major stance change from the way Powell spoke at the FOMC press conference and from the subsequent speakers is that we went from an environment where the expectation was stable data or weaker data gets us easing, but stronger data, you won't get the easing. And now we flipped to where weaker data gets you easing, but stable data and stronger data doesn't get that for you. And the problem with that is that while, yes, overall inflation is still, above target, and yes, there are concerns about an AI bubble and all of that, the truth is other parts of the economy are being tightened into recession. And that's the housing and small businesses and all that. And you can see it, right? Small business capex really never picked up post 2022. Housing turnover is running way below where it's historically been. And so the way I look at it is kind of to say, yes, the quote unquote neutral rate that Powell talks about all the time, that he says they believe they're modestly restrictive on, is a concept that the idea is at this rate, at this, fantastical neutral rate, we are neither stimulative nor restrictive to the economy. And the problem with that is because the fiscal side is such a bigger impact on the economy, there's many economies to think about. Okay, and so there's not one neutral rate. There's kind of really three neutral rates. And those three neutral rates are what I mentioned: AI, small business, and housing. And the small business neutral rate is probably somewhere 50 basis points below the current. So we're still tight there. And the housing neutral rate is probably 150 basis points below. And so that dynamic is part of how the fiscal, kind of drives the monetary side. And then there's this interplay between AI and fiscal, where what I mentioned earlier, the question is, what will the Fed do? What should they do, right? Should they tighten to keep the bubble from happening? Or, should they ease for housing and small businesses? And my argument is that the most likely path, and there will be stops and starts to it, is that they start to focus more on the small business and housing side. And there's three reasons I think this. So one is they're incredibly politically important, right? And yes, the Fed is independent, but the Fed also can't be hostile to the political side. And so that actually the fastest way to lose the independence is to be hostile to the political side. And so that's likely going to be at least some part of the conversation, maybe not explicitly, but implicitly. But the second two are actually just as important. I mentioned earlier, the Fed's best shot at long-term stable inflation is AI. So for them to keep it tight or even tighten to slow the AI bubble is actually very much counter to what they're trying to achieve. And I don't think that conversation has fully entered the Fed yet, but I think it's a very important one. And the third one is that the history of monetary policy is that really what it's doing is managing capital availability in the private sector. Okay, so things start to overheat, credit gets too easy, so the Fed starts to pull it back, and then capital availability starts to weaken, you get a recession, and the Fed restarts it. The thing is, with a deficit of 6%, it's not just the private sector that needs the Fed's capital availability. The public sector matters a lot also. Funding treasuries is part of that calculation suddenly. So the way I like to think about the need for liquidity and how liquidity works is a very simple imagery of a waterfall. right? And so you have this waterfall. The top buckets are treasuries. Those need to get filled up first before everything else below it can start getting some liquidity. And so below there is, investment grade, and below that is, kind of the high yield and the more speculative stuff below that. And what happens is when the Fed starts pulling back liquidity, all the stuff that needs it most gets hit first, right?
It's like a
But
structured credit. It's like an
yeah,
asset-backed security, a CDO or
exactly.
something. Yeah.
Exactly. That's a perfect example of it. Historically, it was never really a concern that those top buckets wouldn't get filled, right? It was just a matter of managing the overflow. Now you've more than doubled the number of buckets in that top row. And so you need more and more liquidity just to satisfy the government. And that means that when you start to pull back liquidity, it actually hurts the private sector much faster than what we're used to. And so, because of those three reasons, it makes a lot more sense for the Fed to kind of manage the neutral rate towards the small businesses, maybe not as extreme as housing, but somewhere in that area, than to think about the the potential, AI bubble. Because if you try to slow the AI bubble, you may have the indirect impact actually of hurting your long-term inflation, chances of getting at 2%, and of hurting the government side, which is completely a non-starter, right? So when we kind of take that all together, it creates this mosaic of an economy that's not just what we usually talk about as the economy. There's these three different parts of the economy, all of which act quite differently, all of which are being highly impacted by a very intrusive 6% deficit. So that's, I think, the big picture way to think about it. Now, again, let's pull that back to the question of the three rules for positioning that I mentioned earlier. Okay, so those rules are, in an environment like this, it's extremely important to have the government behind you. So knowing what is the fiscal side really going to be focused on. This has been crucial the last few years, right? If let's go back over the last 3 years, where you had a nominal GDP boom for a period of time.
Mm-hmm.
Historically, if you told me there was going to be a nominal GDP boom, I would have told you, you should go buy chemicals and transports and all those things that are super high beta to the economy. That was the worst thing you could have done.
Yeah, those things have not done anything.
Right. So, but why? Why in a strong nominal GDP environment were those areas so poor? And the reason is because it was a strong nominal GDP environment that was dominated by fiscal. And so, if you were understanding of this, what you realized was, like I mentioned earlier, the transports, the chemicals, they're going to get the negatives of higher interest rates. But if you looked at the other parts of cyclicals, manufacturing, beneficiaries of the IRA, those guys did quite well over the last several years. Because yes, they had higher interest rates, but the fiscal side more than offset that. So number one is follow policy. You want to look to the real asset economy that's not being disrupted by AI and make sure it's getting a tailwind from the policy side. So that includes like government designated strategic industries, which the Trump White House has been very active on. It includes areas like housing supply, which is going to be incredibly important for the administration to be focused on. So that's number one. Rule number one, follow policy. Rule number two, being in AI enablers. And so we distinguish AI enablers between AI infrastructure and AI implementation. So far, the trade has been all infrastructure.
Mm-hmm.
For this to play out, the next stage has to be implementation, right? Otherwise, all that infrastructure is going to be, oversupplied. And so, like I said earlier, if you're an AI enabler, then you get the benefit of a productivity boom on the demand side. And so it's crucial that you're connected to where the demand is being created and where policy is at your back. So that's rules one, rule two. Rule three is avoid the middle. Okay, if it's not an AI implementer, if it's not a fiscal beneficiary, and if it's not undisruptible from AI, then sure, it'll get upswings when you get an ISM upswing. You'll get upswings when liquidity is very strong. But in general, it's likely to lag significantly. And most importantly, it's going to be really, really hard to identify who the winners are in that area. Because whoever the first mover is, their incentive is to price down to current margins and just basically take share from everyone else. And so that's where a competitive economy, a competitive industry becomes a real problem if you're not a first mover in AI. It's the same idea that if you're a very leveraged company, you don't have the capital to invest in AI, you're likely to fall behind. So the three rules: follow policy, be in the AI enablers, and we're kind of more moving towards AI implementers more so, and avoid the middle.
And so, what are some examples of these types of companies? AI enablers? Who are the AI? What sort of industries are those?
Yeah, so from an industry perspective, you think about like, IT services, think about anybody who is generating a massive amount of data themselves. They own the data. They will be incredibly important to the implementation of AI at scale. Anybody kind of on the physical AI side, it's going to have to move from just kind of these LLMs where we go and ask queries to how it's actively being used. And so that's kind of the distinction we make. So the LLMs, the semis, all of that is the infrastructure. And now it's how is it actually used.
And so, which do you like better, the infrastructure or the enablers?
So we liked the infrastructure better. We're now shifting more towards the implementers. The reason is that the cycle really hasn't started or barely started. The pricing there isn't nearly as demanding. And it is the necessary next step. So if the implementers don't start to work, it's really hard for the infrastructure to work going forward, right? Because that's where your return on capital will come from it actually being implemented. The big picture here is understanding that the two most important factors are fiscal and AI. And they play into each other in a very important way. And that fiscal having that 6% deficit in an expansion creates all of these distortions throughout the economy that the only way we can fix in a really easy way without a recession or without inflation is by having a productivity boom. And so fiscal needs AI and monetary needs AI and the overall market needs that productivity boom. And so the notion that we're going to go and try to stop an AI bubble, I think is misguided right now. Certainly there are bubbles in certain areas, right? There's no question about that. But if the Fed went around trying to stop bubbles, it also would stop a lot of technological innovation. And I think that that's a mistake, especially when you have employment weakening, where you have housing so underwater from a turnover perspective, when you have small businesses really struggling, right? And I think this also comes to the next question, which is you hear a lot of people talk about the fiscal deficit as a big negative impact on markets, right? There's this worry that high fiscal deficits are going to crush the market.
Yeah, I think that a lot of people, a lot of smart people, are on your side and my side
Yeah.
of that. High fiscal deficits, if they're controlled, are they boost corporate earnings.
Well, that is true, but I would just say it a little bit differently, which is the point isn't that extreme deficits are bearish. The point is that extreme deficits create extreme outcomes. And those extreme outcomes can be both positive and negative. And the way I think about that is there are four factors that matter to understanding when it turns from being a positive to a negative. And that's what you should be following to understand the fiscal side of the kind of two most important macro factors. And those four are dollar inflows and outflows, right? So if you're seeing a lot of outflows from the US, so you should be concerned about the level of deficit. A significant rise in term premium would be another good indicator that you're starting to have a problem for markets with the deficit. 10-year yields sustainably above nominal GDP and an unanchoring of inflation expectations. All
So
of
you're okay.
those are
So those four things, Dan. You're only seeing one of them. You're not seeing a dollar outflow. You're not seeing the 10-year higher than GDP. I guess you are seeing term premium widen. That's the only thing that's happened, right?
that's exactly.
But
Yeah.
term premium widened from an extremely low level. As a matter of fact, negative. So compared
Right.
to all of 1980 and 1990, the term premium now is like a joke. It's so small. So yeah, I don't. It doesn't sound like we're seeing a huge concern over fiscal deficits. You're seeing a lot in the press, and there are economists who don't manage money are like, a lot of them worry about it and stuff. But I don't think that from the market you're seeing that concern.
So there's a good reason to
Although
worry about
price
it.
of gold, price of gold though,
Yeah.
yeah,
So
that's
so
concerning.
there's but so the thing is, price of gold is also reflecting the liquidity that's being created by the Fed and Treasury because of the large deficits. So the price of gold has actually been highly correlated with the S&P over the last several years.
Yes.
Okay, so the question is when you worry about gold and the S&P really diverging. And I think those four factors are when you worry, and they're not really flashing red right now. Okay, so the worry shouldn't be, I would actually put it the other way. My biggest concern right now would be if the deficit went from 6% to 3.5%, 4% quickly. That would be very bearish,
Which is
right?
what the Trump administration said it planned on doing, but maybe it doesn't look like it is going to do that.
Because it would be very hard to do that without creating recession.
Mhm.
Very hard. And so that's I think why it's that whole hope to do it stopped pretty quickly. But the point is that what that means, see, when you get into the worry of those four things, when those are flashing red, then the Fed easing is not so bullish, right? Because then you actually worry about the impact on the dollar and all the other factors. We're still very much in the realm of Fed easing is bullish and Fed tightening is bearish. And that is why, again, coming back to the reaction we've been seeing over the last few weeks, it's a reaction to the Fed saying we may not ease. Now, if you're really worried about the deficit, that would be actually a relief to you. So when you talk about the economists worrying about deficit, there's good reason to worry about the deficit from a long-term economic perspective. The only question is when you translate that into your portfolio. And those four signposts are not flashing at this point.
Yes. And most countries, perhaps all countries that aren't the US, tend to have a lot of problems when they run chronically large deficits. We've been able to get away with it for a very long time, and
Well,
that could change
look,
at any time.
yeah, it can change, but remember, our large deficits have been coupled with the highest returns on capital in the world. And so, you can afford a lot of problems if you keep giving the world higher and higher returns on capital. If you start to see those returns on capital weaken, suddenly a 5% deficit is more of a problem than a 6% deficit if returns on capital are weakening. And so I think that we focus on one side of the ledger, but it's important to realize there's a reason everybody has wanted to invest here, right? And it's not just because it's momentum and markets are going up. It's because markets are going up because margins and returns on capital keep on rising here. And when that stops, we'll have a real problem because then you've really exhausted a lot of the different levers you can pull. But I don't think we're there yet, and that's why I think Fed tightening is really the concern here. Because go back to what we said earlier, the Fed tightening is really putting the screws to small businesses and housing, and that's the real concern to be worried about at this point.
I think it's important to underscore that the remarkable profit growth in the US is not mirrored by the rest of the world, and to some degree justifies this bull market we've had not just for the past 3 years or 5 years, but 15 years or even longer, and that over the long term profit growth is the biggest driver of the S&P. And I think you're a macro guy, but you focus a ton on fundamentals, and I think that is really a beautiful and very impactful space when you look at both of those things. I think a lot of people who only wear the macro hat tend to attribute like any bull market to liquidity or technicals or other factors other than the long-term fundamental driver, which is corporate earnings growth. And the fact is that in the US it's been very, very high.
Yeah, look, everything starts for me with returns on capital,
Mhm.
right? And let me put this in perspective in terms of your point about U.S. versus non-U.S. We talk about the U.S. being very concentrated. The truth is, it's actually less concentrated than most of the other major countries out there in terms of the equity index. We also talk about the U.S. being very expensive, and it's true, right? The PE is expensive, it's high, but it's important to also recognize that if you look at the highest quality large caps, their free cash flow margins are in the 98th percentile of history.
Relative
They're
to themselves or relative to everyone else?
relative to themselves,
Okay.
okay? And their valuations are in the 98th percentile of history. That's not what a classic bubble looks like. The classic bubble looks like where valuations are demanding higher margins before they come, right? The question on the large caps is not, are we in a valuation bubble? The question is, are free cash flow margins sustainable at these levels? And that's a very different question. And that's, I think, really important because it goes to exactly what you were saying, which is there has been excellence in the ability to create higher and higher free cash flow margins amongst these large caps that have been outperforming. But where I think the real opportunity is when you look forward is the fact that when you look in the SMID cap space, the highest quality SMID caps, and in this case, there's a lot of different ways you can define high quality, of course. But in this case, let's just talk about the highest quintile of free cash flow margins. Their free cash flow margins are in the 95th percentile of history to themselves, and their valuations are in the 60th percentile of history. And that's where we think the real long-term opportunity is, because it's the only place in the market you actually see a material margin of safety. It has occurred a couple of other times, both on the upside and downside, both in large caps and small caps. And every time it closes, it closes over the course of several years. But the truth is, there's no good reason that if your free cash flow margins can stay at a very elevated level, that your multiple should stay at a depressed level. So over time, I think that's where there's real margin safety and real opportunity in markets.
Fiscal AI is the fastest growing stock research terminal on the internet. They combine a modern user experience with complete financial data on all stocks globally. Not only does that include 20 years of standard financial statements, but they also track company specific segments and KPIs on over 2,000 companies.
That's right, Jack. Want Amazon's cloud revenue? They've got it. How about Spotify's premium subscribers? Or segmental analysis of the different luxury verticals at Hermes? This is data that other platforms just don't track, even though it's the data that really matters. They've got all of that and literally millions more data points. And unlike legacy equity research platforms, Fiscal AI's data is real time, so it's updated within minutes of company earnings reports.
And Max, there are so many more features, including earnings calls, transcripts, financial modeling, best-in-class charting, portfolios of super investors like Stan Druckenmiller and Chris Hone, and they even have an easy-to-use data API so you can export data and build your own models in Excel. Fiscal AI is changing the way investors conduct equity research, whether it's individuals like us or institutional investors like Van Eck, who have their whole research team on the platform. But don't just take our word for it. Sign up for a 2-week free trial at fiscal.ai/mm to see for yourself. And if you upgrade, our link will get you 15% off your first year on any of their paid tiers. Again, that's fiscal.ai/mm. Let's get back to the interview. So Dan, you said that these large cap US names, the Mag7 maybe, are in their 98th percentile of free cash flow margin. I'm sure that as you measure that's true. But going forward, don't you see that these free cash flow margins are going to decline materially? And I mean, Meta and Microsoft and other companies that are spending all of the money that goes to, half, NVIDIA, as well as the other chip designers, the data center builders, and the rest of them, if they don't see that return on invested capital, I mean, the free cash flow is going to go negative. Could go negative quite quickly. I mean, just based on what they're saying about their capital expenditure.
Mm-hmm. Yeah, no, it's certainly possible. I'm just finding where we are.
Yeah.
Right. I've heard people talk about for the last 3 years that we've been in a bubble.
Mm-hmm.
And I think it's really important you can't just look at valuation without anchoring it to something.
Absolutely.
Right. And I always give the example of an individual company. If you had an individual company that was trading at 10 times earnings with a 5% return on capital, and then you kind of woke up 5 years later and it's trading at 20 times earnings with a 20% return on capital, that's not a more expensive company. It's just a better company. And that's what the last 10 years has looked like for the really high quality large caps. Going forward, that's much more of a question. Absolutely. There's no question about it. In fact, you've started to see the incremental change in free cash flow margin and returns on capital for the highest quality large caps start to slow materially relative to those highest quality mid caps. So you're starting to see it. The market's not reflecting it yet. And I think there's decently good reason why the market's not reflecting it yet, which is these guys have earned the benefit of the doubt. I mean, they have been phenomenal for long enough to earn that benefit of the doubt. And at the same time, if you're investing outside of the AI area, the question you have to ask yourself, and I think a lot of people are asking, is while everybody's worried about how inflation has been high and what's that going to mean for Fed policy, there's another side to that, is say, how in the world do we have parts of the economy in recession with a 6% deficit? That should be massively stimulative. And so I think people are looking in the mid cap space and saying, well, if you're not getting an acceleration from them now, when in the world are you going to get it? Because the deficit can't go much wider from here without causing a problem. And the Fed can't add that much more liquidity without causing issues. And so when's it going to come? And if it's not coming now, then why am I paying for it? And I think that's a very reasonable thought. But if you do get productivity enhancements from AI, then those areas that aren't what I mentioned earlier, the margins getting competed away, those areas that actually are not disruptable and have high free cash flow margins can actually do quite well. So there's going to be a lot of dispersion within markets over the next several years, in my view, because the large deficit and the AI aspects of it are going to cause that large dispersion.
So, what is your view on the return on invested capital of these large hyperscalers? The average dollar being spent on data centers and AI chips, GPUs, is that return on invested capital going to be high? Is it going to be moderate but adequate relative to the relatively low cost of capital? Or is it going to be insufficient and result in huge losses as the depreciation expenses pile up and there's just not enough revenue?
Well, funnily, the answer to that might be yes, right? We might go through phases of all three of those. You're likely to have a disappointment phase. That seems like it just, you'd have to really thread the needle not to get some kind of disappointment phase. But that, I think people think about the disappointment phase as the end phase. And that's not necessarily the case, right? In every cycle, you can have periods that, you start to see that incremental negative on returns on capital, and then it actually turns back up because what you were trying to do actually starts to play out. So I don't think the answer is clear, and I think that there's a long way to go before we have enough information to say that with certainty. My approach to markets is not to try to guess, what's going to happen there and what's going to happen here. It's to really have a full understanding of what is currently being priced, what are the unavoidable aspects of what's happening, and then go from, okay, so now where's the best opportunity based on that framework. So I can't tell you I have a solidified view on what the next move for return on capital is for the hyperscalers. What I can tell you is that without the AI that they're building out, really nothing else has a chance to create those higher returns on capital. And so I'm focused on the rest of the market and understanding that those guys have an incredible track record of creating value. Maybe this will be a slip up for them. That's certainly possible. I think that I have to think about in terms of what's the impact on the broader economy, because I don't think I have any edge in figuring out what Microsoft's return on capital is next quarter.
Okay, and you called it a slip up, but this would be perhaps the biggest slip up ever. I mean, people pull their hair out, but oh my God, Facebook Meta is buying Instagram for $1 or $2 billion, and obviously that was probably one of the greatest acquisitions ever. But if that didn't go well, okay, it's $1 or $2 billion. I mean, the amount of money now is being spent by these companies, as I said, is
No,
in
but
the hundreds of billions.
when I talk about a slip up, I'm not talking about the whole thing doesn't work. Yeah, that's a massive problem. The slip up is a timing issue.
Okay.
Is it working in the time frame that everyone was hoping, or just take a little bit longer? And so that's what I'm saying. There could be a period here where people say, wait a minute, why aren't we getting the acceleration in adoption that we hoped for? But that's not the end phase. That doesn't mean it's over. And so, yes, I 100% agree with you. If this AI cycle doesn't create the adoption and productivity that we're hoping for, we're going to have a lot of capital that's been destroyed. There's no question about that. But that's not really what I'm describing when I say slip up. What I'm talking about is this is the long haul, right? And you think about the tech bubble is similar, right? Everything that happened in 98, 99, so you ended up with this huge bubble that ended up collapsing. But the underlying fundamental things being built out have mattered for the next 20 years in a way bigger way than anybody was expecting at the time. So it wasn't over in 2000. It was actually just beginning. It was just that equity prices were adjusting. So those are two different things. And I think you have to focus on them in two different ways.
So I agree. Long term, yeah, the benefits of the building out the internet. I mean, we live in the internet age, no doubt. But the companies that were spending the money, it was a disaster, and it was an utter disaster for the companies that build out all of this cable optic fiber. Are you saying are you putting the question of whether the hyperscalers are going to encounter the telecom bust issue? Are you putting that in your too hard pile?
Oh, absolutely. But also it's
Yeah,
not the same, right? Because these guys all have cash flow generators separate from just
yeah.
laying groundwork. So it's just not the same. But again, as you know, I take everything from a macro perspective. I want to understand how is this going to impact the overall economy and what that means for markets, for returns on capital broadly, right? For margins broadly, and then understand where to invest based on that. And so I think that bringing it all together is what's most important. I don't know what Microsoft's going to do next. It's never been a focus of mine. There are bottom up guys who are going to be way better at that than me. But I think I can understand what the big picture tailwinds and headwinds are, and what the necessary tension that's going on in markets right now is. And that tension is exactly the fiscal and the AI, and how those kind of play together with monetary policy.
Thank you. What are your thoughts, concerns about what has been called the circularity of the AI build out, and in particular how it is financed? So, Microsoft owns OpenAI. OpenAI is a massive client of all of these guys. You have certain companies financing themselves with off balance sheet vehicles. So Wall Street is getting involved. Pretty Gordian financial structures. A lot of, NVIDIA is an investor in a lot of companies that are its clients. What is your reaction to that?
Yeah, I mean, it's actually been pretty remarkable how quickly that ramped up, right? I mean, 6 months ago, we were all talking about how, yeah, maybe a bubble, but it's mostly being financed out of cash flows. So how worried should we really be about that, right? And now suddenly, this proliferation of kind of creative financing, right? One of the things that I think the mega caps realized is their balance sheets are a massive asset for them in all of this. And so, yeah, there's a lot of guys out there who aren't getting the financing they need. Well, we can become the financiers as well as the builders of this. It's it's a concerning development from a more medium term perspective. It is the necessary development for it to get concerning, which is why I think 6 months ago all the concerns were kind of misplaced, because you didn't really have the credit concerns from it yet. So, yeah, could it unravel? Sure, but if it's all being financed out of cash flows, so they'll stop financing it, and they still have great businesses, and maybe you have an valuation adjustment, but things go on. Once you have the debt, it's really being financed by debt. That's where you have the bigger concerns of what if it goes wrong. And I think next year is actually very telling for that, because and it goes back to, it's all very circular. It goes back to the importance of the monetary policy side, because if monetary policy isn't creating more liquidity for the market, and the deficit is staying high, and like the imagery I used before, which is you have all those buckets at the top level needing liquidity. Well, it's not just that the other levels need liquidity. They need more liquidity than they had last year, because there's a lot more issuance coming than you had last year. And so excess liquidity, even if liquidity is still strong, excess liquidity next year is likely to start to weaken. And the way I define excess liquidity in this case is just the total amount of liquidity less what's needed to really finance projects in the economy, right? That excess ends up in financial markets and ends up lifting valuations. Next year is going to be a year of weaker excess liquidity, most likely. And it's precisely because of what you're describing, which is there's more and more issuance that's needed to come. It's definitely a concern for me, but the concern should be from a liquidity perspective, right? You don't get these bubbles really popping until either the underlying fundamentals just completely come out from under you, or they start to pull back liquidity. And I'm more worried about the second one than the first one in the near term, right? Because the fundamentals, like I said, on a timeline basis, maybe they don't work as fast as we hope, but it doesn't look like the fundamentals are just coming out from under you right now. But if liquidity starts to tighten, that will become fundamental, because everything you plan to do will be more expensive or not even financeable. So I think about it like you're talking about it from the fundamental perspective there. I'm thinking about it from the macro perspective, which is it's going to use up more and more of liquidity in the market, and therefore it's more and more important for the Fed to actually be providing liquidity. So it actually creates, once again, a very important macro factor that goes beyond just how AI is being financed, but actually what it means for the overall economy and markets.
But how important is the Federal Reserve in affecting the demand for investment grade corporate bonds or junk corporate bonds, which is going to be financing this AI build out? So, there's a great chart we can put up from the Wall Street Journal showing how investment grade issuance from the hyperscalers, Microsoft, Amazon, et cetera, was very low 2023 and has picked up 2024. This year it's huge and could get even bigger. So that is going to require a lot of cash. But there's tons amount of cash in the system, tons amount of market in money market funds, tons of people who could de-risk and sell stocks to buy these investment grade bonds. And also, I feel like everyone now is, the doom porn chart is showing the credit default swaps on Oracle has widened out materially. and that is concerning. Probably some hedge funds placing a bet, a hedge probably, but also not nearly as many people talking about the PIMCO deal. Like PIMCO made $2 billion in a day by financing Meta's debt with Blue Owl and other people. Like I feel like if there are financial firms that can make $2 billion in a day by taking a gamble in the bond market, like they're going to do more of it. So I think that regardless of whether I'm right or not about that, what do you think about my claim that it doesn't have that much to do with the Fed?
I think it has a lot to do with Fed.
Yeah. Okay.
It
Okay.
has a lot. Everything has a lot to do with liquidity. So there's liquidity
Interest rates
coming
or
from
balance
the Fed,
sheet? Interest rates or balance sheet?
all the above.
Okay.
The thing is, liquidity comes in different forms, but it ends up as liquidity. So if you reduce interest rates, right, you're creating easier financing at the short end, which cascades through, so long as you don't get like this massive steepener, right? That's the typical impact. The balance sheet would be even more impactful because it could directly target the longer end. Okay, but it doesn't matter. Liquidity is needed regardless of how it comes, and I think it's incredibly important. There's a few reasons why. So one is if liquidity isn't coming, so maybe you're right. Maybe the demand continues to be strong for IG. It's going to be strong at higher spreads though, because there will be incrementally more concern on the overall economy and faster than what we're used to because of what I described before of the treasury needing to use more and more of that liquidity. And so you could still have that demand, but it would come at wider spreads, which makes everything more expensive, which concerns the market on, well, what about the next deal? How does that get financed? Right? That's number one. Number two is how much of the inflows from overseas have been coming into corporate bonds in the US. Well, if you tighten liquidity, you typically get a stronger dollar. Stronger dollar makes the purchasing power of all those overseas investors weaker, right? And so strong dollar is an important input into liquidity, actually.
But it also strong dollar also makes those foreign investors and portfolio managers look good on paper because they said, "Oh my God, we allocated to dollar assets, and if they didn't hedge the currency, they benefited."
Yeah, what you're describing is a dynamic of what we saw pre kind of 2022, which is where liquidity was strong and the dollar was strong. That's great if you're investing in US assets. That's perfect because liquidity is strong enough to keep the economy going. But the reason the dollar is strong is just because our economy is better than other places. If dollar strength is coming from weaker liquidity, then that dynamic won't be very helpful because it'll be tightening the economy in other places to where now you're concerned about a default elsewhere. So I think the Fed liquidity is actually crucial to the financing of all this AI at a decent level. Now, we're okay. As I mentioned earlier, I think the AI neutral rate is above the current rate. So it's not like we're having a problem with that right now. But the reason I describe this whole thing is because the more AI is going to get financed before some small business gets financed from a liquidity perspective. And so the more that AI is taking up the excess liquidity, the harder it is if the Fed isn't expanding liquidity, the harder it is for the guys who are below them. So I think it's crucial to the entire universe of financing. Even if AI is a little less sensitive to it, it still matters.
So that's a crucial point that's been you've been saying throughout this interview, that there's three different neutral rates for the real economy, manufacturing, and housing, and then for AI. And yeah, the neutral rate for AI is so much higher. I mean, like I think
Mm-hmm.
interest rates could be at 9%, and the AI build out would look pretty similar. I don't know if it's that extreme, but
Yeah, I think 9% would do it. I think
yeah.
you'd collapse it at 9%. But I agree with the sentiment. It's decently higher than we're currently at, and I think that's crucial. And look, that's why all the money's been flowing to AI, right? If I look in the economy, there's only one area where we're well below the neutral rate and is seeing growth. So all the money should flow to there. That makes total sense. And the problem is if the Fed comes off of off of this easing bias and to a tightening bias, it becomes a real problem for everybody else. And so that's kind of the dynamic that's playing out that you just described. But I wouldn't belittle the importance of expanding liquidity even to AI. Not to say it's going to collapse AI, but it would slow it at the margin, which would get people concerned.
And how much does the Fed need to ease and lower interest rates by? right now we're at just below 4%, and by the
Mm-hmm.
end of 2026, the current market price is a little below 3% of 2.9%. I mean, would that do it? What's your estimate of the neutral rate for the real economy?
Yeah, so I think the small business economy is somewhere right around there, 3%. I think you are getting stimulus in 1Q that I mentioned earlier that will help also, right? You can do two things. You can lower the rate to meet the neutral rate, or you can stimulate the economy, which lifts the neutral rate. So I think small businesses will get some help from that stimulus in terms of getting closer to where the rates are. But yeah, I think it's for the small business side, I think it's close to 3% is where you would get capex really coming back from small businesses. And on the housing side, the way I think about it in a really simple way is the average mortgage rate outstanding is 4.1%. The current mortgage rate is 6.3, right? So that's about 220 basis point difference. Usually to get to the low end of normal housing inventory turnover, you need to be within 50 to 100 basis points of the average outstanding mortgage rate. And so that's why I kind of say it's probably another 150 basis points lower, 100 basis points lower, let's say, to get to kind of the low end of normal housing turnover. One of the concerns there is you may never get there because if investors step in sooner than that, then the average guy is, you don't get the mortgage rate to where you need it to help him. That's kind of a different issue. But the point is, that's kind of how I tier it. Housing is, I'm not trying to be overly, specific, right? Exactly 100 basis points or exactly 3%. The point is, it's somewhere in that vicinity. It's lower than the current rate, and the housing is even lower than that.
Okay, that makes sense. So the current GDP now forecast for this quarter from the Atlanta Fed is 4.1%. Why are GDP forecasts so high, and what's your sense of just how much that is the AI capital expenditure, and might that be sending a false signal of economic health if the gains from this economic boom are so concentrated in one industry and among such a small number of people?
Yeah, I think yes is my answer. I think it is. It could be a very false signal. It a lot of the gains have been AI related, right? Even in the construction space, like when you drill down to a lot of them have been AI related, and so that is clearly going on. You look at residential investment, it's been quite weak. You look at non-resi X the AI related stuff has been actually pretty weak. Part of your strong GDP growth is also the deficit having been pretty wide. So all of those things are contributing to strong GDP growth, which I think optically makes it look like a really strong economy, right? And I'm not here to tell you like the economy is actually in depression. Like that's not what I'm saying. What I'm saying is there are parts of the economy that are experiencing recession, and fairly large and important parts of the economy, but they're not big enough anymore that they are taking down the whole thing at this point.
And what would that be?
Um,
Housing, manufacturing?
Housing, kind of all those ISM sensitive areas that I mentioned earlier, like transports and chemicals, and really the entire small business economy. When you look at like NFIB capex plans, they've never really recovered from 2022 when rates went up. So, I think that dynamic is definitely playing out. I think it could be a false signal that would be a real problem if we react to that false signal. I think that the flip side to that is you are getting stimulus in 1Q. And so you could get an ISM upswing on that. In fact, I think it's likely that you get an ISM upswing on that. But if the Fed reacts by taking out more cuts because of it, then it will be short lived, and that will be the concern for markets.
And what is the stimulus? Is it just the tax cuts in the one big beautiful bill, or is it other things?
Well, so you have the tax cuts, right? You have the full expensing, capex and R&D and all of that. But I think it's also important to realize globally, right? Germany's doing more stimulus next year than basically they've ever done before. The majority of major countries now have some form of capex expensing right now. And the aftermath of the April 2nd Liberation Day, I think was really important to understand, which is that April 2nd, you had this enormous announcement that made people very concerned over the economy. April 9th, I believe it was, where you
Yes.
kind of got that 90-day reprieve. In between there, you had all of these governments saying basically, we need to stimulate internally. Our model of growing our economy through exports may be in trouble now. And the only reaction we can have to that, we can't, the concern was, well, these guys are all going to take it on the chin. And the problem with that concern is it assumes they do nothing, right? But the truth is, the only logical reaction from a political perspective is they need to stimulate internally. And so that's what you got. You got announcements around the world that you were getting internal stimulus. And look around the world. Look at all the major countries in the world. Domestic demand as a percent of exports has been falling for decades. Basically everywhere else in the U.S. And that's the chart that they are looking at now and saying we need to start to reverse that because we're at risk on the export side because of the tariff regime. And so you have stimulus coalescing early next year from all those different acts that took place following Liberation Day that I think will actually be pretty positive for overall growth into early next year. But like I said, it's a temporary form of stimulus.
Sounds good.
The only thing we haven't covered really is the notion of can you actually ease for small businesses and housing at the same time, right? Because when you have this large deficit pushing on inflation, then when you ease at the short end into stimulus, the concern is that the curve just steepens, and
Which is what happened in September 2024. Yeah,
correct, and the long end stays sticky.
Mm-hmm.
And what that means is, so small businesses mostly, as I mentioned earlier, they finance at the short end, and housing finances at the long end. And if you're gonna, is it going to be possible to ease for small businesses and at the same time ease for housing if the long end stays sticky at a higher rate when you cut into stimulus? And that's a concern right now from a political perspective, from a policy perspective, from an economic perspective. And I think there are basically two ways to handle that. One is that the Fed cuts to help small businesses, and they worry about what they can control most, which is the short end. And you utilize basically, the executive branch, the White House, to ease regulations on mortgages and on banks to help mortgage spreads come in. And you kind of handle it that way. Or you have a new Fed chair who says, we're going to use the balance sheet to help the long ends come in as well. Without that, easing into stimulus creates that tension that can become a real problem. And it makes it really, really tricky. Yet another added to the list of distortions that are created when you have a 6% deficit in expansion.
Do you think that the housing market can go down and that actually be a good thing for the economy because it increases affordability, unlike in 2008? Because, we've had strong housing markets over the past 60 years when interest rates didn't need to be, 3% on the mortgage rate. Like 6% historically is not insanely expensive for a mortgage rate. It only seems like it because people are used to a 4% mortgage rate.
Yeah, look, there's a lot of equity embedded in housing ownership right now. So it's not the same as 08 at all.
No.
Where a 5% decline in a house actually wiped out just a ton of equity and wiped out even the some of the mortgage value there, right? So it's not the same. At the same time, housing is still the most important asset for most people. Seeing that decline, I have a hard time saying would be good for the economy. If you want to take a much longer view, a 20, 30-year view, then sure, reestablishing housing affordability will be very important. But it's hard to say on a 1 to 2 year outlook that a real decline in housing will be good for the economy. I think the only way you can deal with housing now in a real way is by increasing supply, right? And so this goes back to when is policy at your back, right? Those 3 rules for positioning we mentioned earlier. The government has to look at areas that you can increase supply of housing without simply, essentially increasing the value. Okay, so normally what they do for affordability is you take interest rates down. The problem is that then prices go up and you're back where you started. But you have areas like, for instance, manufactured housing, which you're seeing talked about more and more on the policy side, that can build houses at a fraction of the price that the site builders build at. And so when you look at something like that, that should be a target area for policymakers. And even though it's in the housing, in the housing realm, right, they should be where policymakers want to be creating more demand, right? Because you can you can build at 30% less than a normal house cost, than a site-built house cost. And so, like, those are the kind of policy directives and initiatives that you really need to take to increase housing supply to create long-term affordability. If you're going to try to create short-term affordability, either that happens through prices, not great for the economy, or that happens through interest rates, which will be short-lived. So that's kind of the a little bit of a catch-22 for a policy, and why they really, to me, need to focus on supply.
Dan, how important are tariffs? And yeah, what are you thinking about tariffs, and how has your thinking of tariffs changed over the past year?
So the answer to the second question is actually very little. I've always viewed tariffs as a tax. The way I described earlier, a recession is not 2 quarters of negative GDP. It's a self-reinforcing negative cycle in the economy. Is the same way I think about inflation, right? Inflation isn't just prices go higher. Inflation is a self-reinforcing cycle of prices going higher, where then you get inflation expectations up, then it brings forward purchases, and it creates even higher prices, and you have that whole cycle. Tariffs are not that. Tariffs are a mechanical rise in prices that then weakens demand. And so I don't think about it in the traditional way that you would think about inflation, even though, yes, prices go up initially. And I think the San Francisco Fed had a paper actually to this effect very recently, which is interesting given that's not how the Fed has necessarily been talking about it this entire time. So the premise that I'm coming up with there, though, is that it weakens demand. And the argument you can make is, well, has it weakened demand? And what I would say back to that is I think the answer is actually we don't know yet. Because yes, tariffs have been in place, but not for as long as they've been talked about.
Mm-hmm.
Right? You had that 90-day reprieve. Right? So that took you into the summer. And even then, in several areas, you got additional reprieves. So the real, full-on tariffs, I would say, hit more in August into September. And it's not to say there weren't tariffs at all, but what you were concerned about in terms of blanket tariffs everywhere, you really ended most of the reprieves in the August-September timeframe. And so I think we're still seeing the effects of that. So I don't know that it's actually you can conclusively answer. I do think it is impacting demand. I think when you listen to company commentary, they're telling you it's impacting demand. So my framework for tariffs has always been prices up initially, but not quote unquote inflation, right? Which leads to weaker demand. I think that's playing out. That's how I continue to think about it. My guess is that if these tariffs stay on, it's going to be kind of a continued kind of break on demand for the time being.
Which would not be good for the economy or market.
No, it wouldn't be. Now, again, remember, there's so many factors here, right? You're going into stimulus in 1Q. So in 1Q, it may not matter as much. But the problem is the tariffs stay, and the stimulus is for a period of time. And so, it's not like I'm sitting here right now saying I'm worried tariffs are about to crush the economy. I think if I have a worry right now, it's that the combination of tariffs and the Fed not viewing tariffs in that way is a problem. And so that's my risk and that's my concern. But it's not my base case right now. My base case is that into 1Q, that stimulus takes effect, but that in the big picture, tariffs continue to be negative for the overall economy, but not an inflationary issue.
That makes sense. Dan, tell us about your firm. You've been doing this now for what, 8 years? Tell us your strategy. Obviously, it's been on display throughout this conversation, but yeah, where do you think your edge is as investors? And just tell us about it.
Yeah, so it's Blue Door Asset Management. We kind of operate on the philosophy that value is created at the company level, right? Value isn't created, trading SOFR spreads. Value is created at the company level. And so we are bottom-up driven with the understanding that companies create value, but portfolios are impacted by the macro. And so everything we look at, we're looking at from both a micro and macro perspective to really understand what's kind of the holistic view of the tailwinds and headwinds impacting these companies. And so that's the philosophy we've taken. We believe strongly that you can't just ignore the macro. What typically happens with funds that ignore the macro is my partner, Mike, gets calls from those bottom-up guys when the macro starts to matter saying, hey, what's going on? Can we talk? What is Dan thinking? So you end up becoming a macro tourist, which is really the worst way to operate. Either stay in and then don't become the macro tourist, which is fine. But if that tends to be what happens, then then you better kind of know what's going on at all times and have a framework for it. And then having a framework for it doesn't mean you're going to be right all the time. But what it means is you'll know how to understand when you're wrong, right? And one of the things I always say is there's two things you care about as a fund manager. Am I focused on the right things, and am I getting those things right? And the bottom line is I'm not always going to get them right. That is, just the nature of this. But I'm very, very confident, very focused on making sure I'm focused on the right things. And that's where we are able to look from a macro and micro perspective separately, right, with no influence on one another's views, and then come together and discuss it, knowing that from a bottom-up perspective, he's looking at the right things that matter, and I'm trying to focus on what matters in the macro.
And a decent part of macro is paying attention to things that actually matter. A lot of macro is paying attention to things that don't matter, and maybe they don't matter, but that the rest of the market is concerned about it. So with regards to tariffs, like I and many other investors were far too concerned on April 2nd and afterwards, but still, if you were running a long only macro doesn't matter portfolio, you would have been exposed to a portfolio shock in April. So you do have to be paying attention to these things.
So yeah, although I would amend one thing you said there. I don't know that you were far too concerned with April 2nd. Maybe we were all far too concerned on April 10th, right?
Yeah,
April 2nd was a shock
you're
to the
right.
economy.
You're right.
And there was a good reason to be concerned. The problem that I think we got into, the market as a whole got into, is we got anchored to April 2nd. And when things changed in the week that followed, in terms of both the rest of the world looking to stimulate internally, and then the 90-day reprieve, we were still anchored to the concerns that we had 5 days earlier, because 5 days is a really short time, right? And it's hard to shift that quickly. But the facts changed a lot in a short time. So when you say in terms of like it doesn't matter, but people are focused on it, well, I think it's more of understanding. No, it did matter, like deeply, but then things changed, and now something else mattered.
Yes. Wouldn't you say though with macro that most macro concerns end up being Nothingburgers, even though they tend to price to be disastrous scenarios, such as April 2nd, March to 2023, bank stocks and stuff. But most things generally work out well, and it's it's rare that something is like a 2008 moment.
Yes, 100%. Most macro concerns are overplayed, and the reason is, I think in the macro world there is a tendency to think of things, like I said earlier, as an end game.
Yes.
If this happens, then it's over, right? And the truth is, no, if that happens, then the next thing will happen. And maybe the next thing is also bad. That's possible, but we have to think about what that sequence looks like, right? It's like, well, if, in 2022, well, now oil's going to $150 and the Fed won't be able to, do anything about it. And, it's game over because deficits are so high, right? And suddenly it's like, wait a minute, but then demand will weaken, inflation will come in, and then the Fed can ease again, right? And like there's a cycle here to understand. And so I think there's actually, I would say, two reasons a lot of macro guys get too bearish. One is they're not focused on that simple thing I said earlier, which is that value creation happens at the company level. And so that's why, as I mentioned, I start my macro process with understanding economy-wide return on invested capital less the economy-wide cost of capital. That's value creation. That's it. Right? And if things are negative, but they're not negatively impacting that, then it'll be a tactical problem, right? And like you can make some money trying to trade it. You can also lose some money trying to trade it. But you don't want to lose perspective of what's really going on, which is 30 years of a widening value creation spread from both the return on capital side and the cost of capital side, right? And so that's number one, is they're not focused on the fundamentals. And the other thing is, I think most macro guys, they start in currencies and bonds and then move to equities. And the nature of currencies and bonds is that they tend to have their biggest move when things are going terribly wrong, right? Equities is not the case, right? Equities can have big moves in a lot of different environments, both up and down. And so I think that it's very easy to get anchored to something big has to happen and therefore this. And remember that like companies are constantly adjusting to improve their process. Policymakers are constantly adjusting to improve the economy and markets. And so you're fighting a pretty uphill battle. And so what you have to figure out is, when are the signposts there that maybe they're making a mistake? Most recessions don't come because they want to throw us into recession. They come from a mistake. And so that's what you're looking for, as opposed to this notion of endgaming it, where when this happens, now it's over.
I think it's so true. Like there never is an end game. I guess nuclear war, but other than that, there never really is an end game. And okay, President Trump has these very high tariffs that is going to destroy demand in the rest of the world from the U.S. Okay, the rest of the world was concerned about that, and they enacted all this fiscal stimulus to combat that. Oh, and by the way, now President Trump is backing down or pulling back on a lot of these tariffs. So actually, the slowdown is not going to happen, and then you're going to have all this stimulus to fight the slowdown that's not even happening. That's such a good point. I also think, Dan, that it's important to say, okay, I don't know enough to answer this question. And I think earlier, talking about the return on invested capital of AI, you kind of said this is too tough of a question with the hyperscalers, but you do acknowledge that that is the dominant question.
Yeah, look, I have to. My job is not to figure out everything that's going to happen, right? Often people ask me, well, "What do you think the Fed should do?" And my answer is
Yeah.
it doesn't really matter what I think the Fed should do. The only thing that matters is what I think the implications of what the Fed does do, right? And so I don't have to know everything. And in fact, if you trying to know everything is a really bad strategy for making money in markets. What I have to do is figure out, A, what are the right questions to be asking? What is the right framework for thinking about these questions? And then what is knowable? And then I want to invest or have hedges on in the areas that are knowable. And so I'm very, it's very easy for me to sit here and say, I don't know, because I don't need to get into areas that I don't know. Somebody else can make money there. Somebody else will maybe know that better than me. But I can focus on what is knowable based on my process and my framework, and just be willing to not know everything, which I think is a crucial part of this business.
And so obviously you like what you own and what your fund is long, obviously, goes without saying. You also have shorts and index puts or other types of products. Are you seeing now an opportunity to either monetize your hedges? Oh my God, the market's gone down, and this fear over AI, CapEx not being there, ROIC not being there is overblown? Or are you saying, no, actually, I think that there could be a little bit of a slowdown in this narrative of AI is going to change the world, bro. And actually, opportunities are to be buying puts rather than selling them.
So I don't think it's the narrative change that will matter. I think it's very basic. Everything comes down to liquidity and growth, right? If liquidity is strong and growth is strong, the narrative isn't changing. If liquidity is weak, suddenly everybody's got a new narrative for what's going on. And so from my perspective, I think about it as, what is happening right now and how does that matter for liquidity and growth? And the truth is, I look to 1Q, I mentioned earlier, the stimulus is likely to be positive for growth in 1Q, with the offsets being tariffs and the potential that the Fed not easing more creates more concerns among small businesses, right? So that's kind of the dynamics. My bias is still towards the positive aspect, but I'm open to having to change that. In terms of what does that mean? What do you want to do right now? The way I think about that is, for the very short term, it's entirely Fed dependent in my view. If the Fed were to start to talk about, well, there's a few people who are more hawkish, but in general, we're still on that same bias we were before, which is, if the labor market continues to be weak like it is, we're gonna cut. Markets will bounce back. The views on liquidity will stabilize again for the time being, and things will be okay. If the Fed decides to push this and say, no, we think we've done enough, and you need further weakening for us to want to do more, then yeah, I think that there's more risk to be had here, without question. Now, what does that mean from a big picture perspective? It means you potentially stay a little more hedged for the short term. I think there are more interesting ways to do it than just index puts. But it comes back to what we said earlier, though, which is, remember, let's think the next step ahead, which is, because of the government side of the need to fund Treasury and the need to fund all this deficit, you can't restrict liquidity for too long. And so ultimately, they're going to have to come back with more liquidity. The question is when, and that's going to matter a lot to markets, is the when. Now, because I don't know that answer, it can upend, right, your long or your short position. The way that what I have found interesting of late is to essentially expressed that with a trade that had been quite weak for a while, which is high quality versus low quality, right? The kind of the high beta, low quality areas had ripped into 3Q. Liquidity was really, really strong and it drove it, and high quality really lagged. I've thought that that's the right way to play this, because if you're not going to get a full about face, it's hard to get the real rip in liquidity again, which means, your downside on the high quality versus low quality is still there. It's not that you can't lose money, certainly, but it's just not as extreme if you're not going to get liquidity really coming back strong in the near term. And on the other side of it, you can get a nice unwind there. And so I think, playing that on a relative basis is in many ways more interesting than the index level, because you could make more. If things go really long, you'll be more being long puts, no question about that. But from a risk reward perspective, I actually think that's a more interesting way to play it.
That's really interesting. Yeah, in this bull market, the thing that's been rallying the most has been the junkier, more speculative names and companies that have existed for 50 years and just grow their profits every single year over year, every quarter. Like those companies haven't done as well. So you actually think that there could be a little bit of a reversal. Maybe we're seeing it already. That's interesting.
Yeah, no, we have started to see it. These
Yeah.
last 2 weeks, we've started seeing it. Yeah.
Dan, thanks so much for joining us. You're a really interesting macro thinker, and I really appreciate you coming on and sharing your views. I just want to say, so you said that the two most important themes are fiscal and AI. It just so happens that our sponsor, who's going to sponsor this episode, is literally the name of the product is Fiscal.AI, which is kind of a Bloomberg replacement tool, really good for fundamental analysis. So if anyone's watching, you got to check that out. If only for the reason because that's what Dan's paying attention to, even though Dan probably didn't even know about the product.
I didn't, but I'm glad I could help your sponsors.
There we go. Thanks everyone for watching, and remember to leave a rating and review for Monetary Matters on Apple Podcasts and Spotify, and subscribe to the YouTube channel. Thanks for listening. Looking to check out Fiscal.AI's innovative equity research terminal? Get your 2-week free trial and 15% off your first year at Fiscal.AI/MM. Until next time.
Thank you. Just close the door.